up next on the SRI 360 podcast.
It's quite clear that ESG integration is now mainstream. No investor who's serious in the market is not going to have at least an attempt, but who's seriously going to have a pretty robust ESG integration approach. No one asks, do you do ESG anymore? They don't even say, how do you do ESG? They want to know all that, but they all want to know what's the carbon footprint of the portfolio? Where's it going? All these SDGs, which ones does this tick? It matters because of credit risk, but also it allows us to become more informed investors. And being a more informed investor allows you to, with as much precision as possible, allocate risk, but allocate volatility contribution that is aligned with that view. Investors are getting much more sophisticated. That's driving investors, us and our competitors, to being more sophisticated, demonstrably so, about ESG integration.
The SRI 360 podcast, presenting world-class investors and experts, passionate about improving the world and making high-performance returns through unique ESG, impact, and socially responsible investments. Here's your host, Scott Arnell.
Hey everybody, in this episode I am visiting with Mitch Reznick, and Mitch is the head of Sustainable Fixed Income and co-portfolio manager of the Federated Hermes SDG Engagement High Yield Credit Fund. He has over 23 years of specialized experience in the corporate credit industry and was previously co-head of credit research at Fortis Investments. He has a master's in international affairs from Columbia University, a bachelor's in history from Pitzer College, and is a CFA charterholder. Mitch is co-chair of the Federated Hermes Sustainability Investment Center, a founding member of the Executive Committee for the European Leveraged Finance Association, co-chair of the Credit Risk and Ratings Advisory Committee at the UN Principles for Responsible Investment, and he serves on the CFO Task Force for the United Nations Global Compact. He's also a member of the Target Setting Workstream at the Institutional Investors Group on Climate Change and a member of the Technical Working Group for the U.S.-based Sustainability Accounting Standards Board. And now, please meet Mitch Reznick.
Yes, I'm American, born in Washington, D.C., educated in California and New York City. The education background, I studied history, and in graduate school I studied international affairs, political economy. So really actually don't have a very strong finance background.
How did you get from history and international affairs into finance?
I kind of happened upon it in between college and graduate school.
I was working at this NGO for several years and I loved that work. And then I realized, got to a point where, peaking at $25,000 a year and into my sort of late 20s was going to be difficult to raise a family in the future. So I needed to get skilled up. So I went to graduate school at Columbia and I got a degree in political economy. And I had thoughts about the Foreign Service. Turns out I've done a ton of traveling through finance anyway, but the Foreign Service opportunities were beginning to fade and international business, international finance was rising. Mind you, I didn't know a thing about finance, but I did take a job at Moody's, the credit rating agency, in a non-credit rating or non-finance role. It was more of a business development role. So analyzing foreign markets for rating services and like large growing capital markets like India and Brazil. I got into contact with that financial analyst side and a job opened up on the credit rating side of the business after I felt like runway had run out.
So you basically got to it like a lot of us did, like serendipity. And then I think you landed at Fortis in a couple of different roles after that, right? Is that when you kind of jumped over the pond and ended up in either London or Paris?
Correct. I wanted to move closer to the trade, having spent several years as an analyst on the high yield side. And there was an opportunity that opened up in Paris. I saw several New Yorkers interviewing all over the place, but it was a good role. And I thought, had lived abroad, wanted to continue to live abroad, thought it would be just a 2-year, maximum 3-year thing. And so my wife and I and our then young daughter, who's now graduating high school this weekend, moved to Paris. And then just the career just continued on from there in the various roles that I had as an analyst, portfolio manager, head of research, head of team, that kind of thing.
You landed in Hermes in 2010, but again, in research on the credit team, right?
In 2006, I moved to London as a high yield fund manager, and then shifted and needed someone to run the research team. And there I did that. And then in 2008 to 2009, there was the global financial crisis. There was a merger at BNP, and I was part of a team lift out to rebuild the credit business at Hermes. So several of us moved over 2010.
And then you were co-head of credit, I think, for a number of years. And then you ended up as head of sustainable fixed income and co-manager for the SDG Engagement High Yield Credit Fund in 2019. And that was on top of what you were doing before?
So the business that a colleague of mine and I sort of kicked off in 2010 started to grow and grow really well and was quite sustainable on itself. And at the same time, having led the ESG integration process from the investment side of things, I could see that we as a house that had a deep ethos, experience, street cred, if you will, in stewardship and responsible investment, we were extremely well placed to come to the market with sustainable solutions. And we had none on the fixed income side. And I said, look, this is happening. I've been to all these conferences. I'm speaking to these things. ESG integration is one thing, and that's great. But the next step after this now is sustainable. We need to build products for the future. We always, try to think about building solutions for where the market is going. And we had incredible resource in the building. We had good track record. So I just said, but I'm going to have to drop this title. In order to do this, we need to show commitment and dedication and resource to this. And this SDG fund that you refer to, that was the first of several products that we launched.
So prior to taking on these titles and the role, you were already heavily into the ESG space?
Yeah, my 20 plus years, it's pretty much, I come about this from the finance side and investor side, right? I'm a finance guy and all that. Per your point, in our view, that ESG, those non-fundamental factors are part of the holistic and complete investment process itself. Everything is contiguous and leads off from something else. And so building a business with solutions on the investment side on sustainability is a natural extension to what we're already doing. The difference being that the kinds of things that I'm building are investment processes and products that are governed by an additional investment objective. That's the difference between a typical mainstream, say like an Article 8 type of strategy, which is that the product needs to deliver financial returns based on expectations, but also outcomes that serve the environment or serve society, like the SDGs or climate change or biodiversity, these kinds of things.
You've been involved with or are on a number of boards and active professional association roles developing some of these taxonomies. Could you just give me a rundown? Because I saw a whole list of these things. Or is it too many?
Not at all. So I'm the co-chair of the Credit Ratings and Research Committee at the PRI, the founding member and one of a handful of people that originally sort of designed and built out the European Leveraged Finance Association. I'm going to work several work streams, one with the IIGCC, the work stream on the CFO task force for the UNGC, which is the UN Global Compact, and I'm on a technical working group on communications and technology at SASB, because I also worked as a telecoms analyst for many, many years. So that's where I had some expertise. So in all these capacities, they're trying to create a connection between sustainability and investments. And that is where I sit, basically.
You're on these working groups as a representative of a very large investor in the fixed income space. So you're very much in the flow of this and represent what the current thinking is. That's important. I just wanted to say thank you for doing that, because we need all that. And I also say better you than me, because I'm not sure I could get through all of that. Maybe rather get my teeth drilled. Let's talk about Federated Hermes, maybe at the 10,000 meter view, because you guys are huge and we can't talk about everything that you guys are doing, but maybe you could just kind of bookend and frame our talk by putting things in context. And then where does Hermes sustainable fixed income funds sit within that? And then specifically, what are your responsibilities there?
Sure. So moving in from concentric circles, I guess, I sit in London and work at the international business of Federated Hermes, a global asset manager covering every conceivable investable asset you can think of. And the international business itself, as I described briefly, has got this history and legacy of the stewardship, responsibility, and responsible investment that sort of weaves into the ethos of everything we do. So everything we do has this component of ESG integration that we described. And as an extension of that, we also are launching and building investment solutions that serve to deliver financial returns, as well as creating benefits, purposeful capital deployed kind of way for social environment, for the society and for the environment.
I understand the approach is to apply ESG principles is that applied universally across everything that Hermes is doing?
You could almost use the European regulators, Article 6, Article 8, and Article 9. So Article 6 is you can't demonstrate a credible ESG integration in your investment process. That's nothing for us. Everything starts with Article 8, where there's a demonstrable, credible ESG integration. And then tipping off. So that's everything that we do. And for your question, I think what I was referring to is that once you start to layer on this additional investment objective, so the strategy is governed by financial outcome and social or environmental outcomes, that's Article 9. That's that more purposeful capital. That is not everything that we do. It's sort of cumulative, right? Everything is this Article 8. And then you take that extra step of this additional investment objective. And that's the key difference where you're looking to serve at the union of financial returns and social and environmental returns.
I think that you guys were early on integrating ESG into your investments. Can you explain to me, why do ESG risks result in improved credit spreads? I know everyone wants this to be true and everyone says it's true, but it's always a little bit like picking up fish for me. And I think you guys have done some studies on it or referred to some studies about credit default swaps are the purest source or purest indicators of the credit spread, and that you get better outcomes.
Let's start with the investment philosophy. The principles of this is that these non-fundamental factors can have an impact on cash flows. And just like fundamental factors that have an impact on cash flows have an impact on the enterprise value of a business. And wheretofore the enterprise value of a business has an impact on the credit risk of a business. So I won't get more technical than that unless you want me to, but if leverage were to stay flat, or the amount of debt that you had relative to your cash flow stays flat and the enterprise value is growing, then this distance between those two, the full value and the leverage, is growing. And that's implied equity. And that's the cushion that you have that sits in front of, almost in defense of the default risk and recovery. So stepping back to the beginning, non-fundamental factors have an impact on all this stuff, then you're compelled to fold this into your investment process. And the nice thing about credit versus equity is that credit is not just you own a bond or don't own a bond. A lot of the companies that we look at have capital structure. So they've got senior unsecured debt and subordinated debt, or they've got a whole term structure, 2-year, 5-year, 10-year, or they've got different securities. And why that matters is because you asked the question about ESG. It's like, well, first of all, it matters because of credit risk, but also it allows us to become more informed investors. And being a more informed investor allows you to, with as much precision as possible, allocate risk or allocate volatility contribution that is aligned with that view. So, for example, by focusing on these factors, we can have a better sense of uncertainty. And if we feel good about it, then we can take more volatility contribution. We can take more risk than we normally would. So it's not just own the name, don't own the name. So you can go long end. Now, last thing I'll say about this is that's fine and good, but how do you know, right? And this was the issue with us about 5, 6 years, 7 years ago in credit committee. We're like, we know from the macro studies and we know anecdotally this all matters. So we did a study. Has anyone tried to price this risk? And we went out to the market and didn't see that anyone had really made an earnest attempt to price ESG risks. So we thought, let's just try to do it ourselves. So we have in-house quantitative assessments of ESG quality. They're called QESG scores. Using this QESG score as a reflection of ESG strength, we wanted to understand the relationship between that ESG strength and credit risk. And a measure of credit risk is credit spreads. What we used for credit spreads was credit default swaps, because CDS in many ways allows you to sterilize the spreads from the effects of bond math, basically, like maturity and convexity and duration. It's basically a credit spread that rolls a 5-year credit spread that rolls every 6 months. You can't get more pure than that. And it's liquid. And so we did a historical study, which is also important, particularly when you're looking at spreads, because bonds mature. In this case, they don't. Using statistical analysis, regression analysis, just show that there is a relationship between ESG quality and weakness and credit spread. So the weaker the spreads, the weaker the ESG factors, the wider the spreads on a relative basis versus the strength and tightening. Now, that was fine and well. I'd say, okay, well, maybe that's just a coincidence. The fact that companies happen to be higher quality credit companies just happen to be good on ESG factors. So we did another iteration of that study to show that controlling for credit quality as per credit ratings, that just using credit quality alone or credit ratings alone isn't sufficient. And we know this because there is a dispersion of QESG scores or ESG quality in each rating bucket, which means that the credit ratings don't explain it sufficiently. So that compels you to look at the ESG factors separate from, say, traditional fundamental analysis. Then we took that and we created a pretty innovative and pioneering curve where we built an implied credit curve based on ESG quality, and that can help you price ESG risk.
You mentioned that you have ESG scoring. I presume that's a proprietary internal screen that you do. And then you've made this correlation. So does this imply that everyone else in the market is doing that? Or does this mean that the crowd is arriving at the same conclusion?
I think it's difficult for me to comment on how much of the market is pricing in the way we have. There have been a handful of studies that have been done, mostly by the sell side and academics and us. Deploying that in a practical way can probably, if you don't have everything in-house, can be a bit more challenging. However, it's quite clear that ESG integration is now mainstream. No investor who's serious in the market is not going to have at least an attempt, but who's seriously have a pretty robust ESG integration approach. Now, we happen to have our own scores in-house, but there are a lot of vendors that are out there, and there are ways to take those vendor scores and do this kind of thing. So the reality is that our investors want this, right? No one asks, do you do ESG anymore? They don't even say, how do you do ESG? They want to know all that, but they all want to know, what's the carbon footprint of the portfolio? Where's it going? All these SDGs, which ones does this take? I mean, the question here, the investors are getting much more sophisticated. So per your point, that's driving investors, us and our competitors, to being more sophisticated, demonstrably so, about ESG integration. And they care about it because they know that every studies and all the studies show that at minimum it's neutral, but more than likely it makes you a better and more informed investor. And that's what some of our studies show.
I wanted to drill down a little bit on the SDG engagement fund that you're actually a portfolio manager on.
It was a global launch. There's a 40 Act in the US and the UCITS. It started out at about 100 million or so. It's now just shy of 1.6 billion.
What I wanted to ask you about is the SDGs in the name. That's UN Sustainable Development Goals. But how do you integrate these into your bond investing? Green bonds have an established taxonomy, but I'm not sure that SDGs do, or maybe they do. Maybe you'll teach me that.
So what I love about the Sustainable Development Goals is they are becoming a kind of lingua franca, a kind of a normalized taxonomy for us to reclassify the myriad of sustainable environmental issues that you can sort of pour water over these issues and it'll drop into any one of these 17 goals, which makes it a lot easier to have discussion and discourse and to assess and measure and track and report on sustainability progression. So they're incredibly useful from that point of view. Obviously, they're also a kind of call to action as well. So you can remap sustainability issues, so those in the environmental and social sleeve of ESG, into these 17 sustainable goals. And companies are now actually beginning to report on the sustainable development goals. So insofar as there's kind of a framework, an investment framework, like there is for green bonds, like there is for social bonds, or like there is for sustainability linked bonds, I don't think there is one because there aren't any pure SDG bonds. Any bond like the NL bond, pioneering issue, does map to SDGs, but that's the outcome. It's not necessarily the link. The link would be a specific KPI, a key performance indication of what it wants to be measured by and what target it expects to reach. From an investment point of view, the fund is actually fairly straightforward. It's a long-only, high-yield credit fund with a stated investment objective to outperform a mainstream high-yield index. The difference is that in addition to that, its objectives are to invest in companies that will deliver positive change in society or in the environment, engagement being the catalyst to facilitate that change. In that sense, it has a kind of laggards to leaders feel to it. It's an impact fund. We're trying to facilitate and create change. The leaders are already well on their way. And we think that there's a link between performance and delivering into those objectives.
Are you doing like green bonds and blue bonds and social bonds and sustainability linked bonds, or what?
Yeah, I mean, the beautiful thing about this fund is we are not a forced buyer of any security because it doesn't have that specific thematic on it. But I will say that the answer to that is both technical and I guess philosophical. I don't know. But from a technical point of view, in the high yield space, there isn't a plethora of those labeled securities at this point. And the ones that do come in, some of them are questionable in terms of use of proceeds. So having said that, there are a handful of those labeled securities in the portfolio, but only insofar as they make sense from the two investment objectives: deliver financial returns in line with the expectations and also facilitate a company delivering into the SDGs. For us, what really matters is how a company is performing at the corporate level. That will affect the entire capital structure, not the single security. So the sustainable linked bond is great. We love them because it's going to keep the company on track to hit those specific objectives. Whether or not we own that specific security in the cap structure depends on the value, liquidity, availability, all those kinds of things.
Could you give me an example of one issuance that you considered to be an ideal SDG aligned issuance?
For something to be an aligned issuance, it would have to have, per your point, it would have to be kind of like a use of proceeds bond, like a green bond or something like that. The proceeds were going toward projects within a company's stated owned, green bond framework. Like, we will only use proceeds with this label that will go towards decarbonization, blah, 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 whatever. Or in line with a third party like ICMA, the International Capitals Markets Association, that's created this really good framework. And then that's also true, same analogy on SLB, sustainability linked bonds, where the issuance would be in line with the SDG if the KPIs speak to, say, a decarbonization trend or something. In the case of NL, that's one example. Suzano, Brazilian pulp and paper manufacturer, have created SLBs that speak to decarbonization environmental trends that benefit SDGs. So I guess you could say that those are kind of SDG aligned securities, but it's really about the change at the company, and the company is the one that's creating it. NL just launched 3 billion euro equivalent in SLBs yesterday because all their financings are going to be sustainability linked bonds, because they might as well be, because that's what the company is trying to, it stated these goals, so it might as well do that.
I think everyone would say this is great. Better returns, less risk while we're all improving our future. But are there any inherent risks in this or downsides to this apart from the usual or say market risks that any traditional bond fund is exposed to?
Yeah, definitely. There are a couple to consider. And one thing I would say is that in thinking about thematic investing in sustainability, you can kind of take two paths. One, you could have an kind of exclusions based, like we won't invest in fossil fuels or this kind of thing. There's a risk that you shrink your investable universe and you give up your right to influence a company, right? Our view is if you're a financial stakeholder, whether you're a bondholder or not, you have the right to have this constructive dialogue or this engagement with the company, but that's justified by your financial stakeholding. So there's a risk there, I suppose, that you give up the influence and can't create change, but also in some cases you'd be out of so many industries that it could introduce tracking error, which is the difference in performance from a volatility point of view of your own fund versus an index. So if you have a lot of exclusions, maybe you should think about a bespoke index. But I do think that there is an element, and maybe this is what you're speaking to, there is an element, the two key risks from this are downsides, I think, are greenwashing and greeniums. Let's talk about the latter first. A greenium is a pricing advantage of a security that is derived from the labeling of the security, and it's a pricing advantage over the unsecured obligations for which the credit risk is the same as that specific labeled security. Greeniums exist in the market. They've been observed in different markets and at different levels. So some would argue that greenium pays for the lack of volatility these securities have, the fact that you're actually doing good. So some would say, like, yeah, that 5 basis points, I'm getting paid for it in this positive externality. But from a performance point of view, there is a disconnect there. Now, I would say right now, the greeniums that exist, they're really small. I don't think that there's a holistic repricing or even alarming repricing of credit risk at this point. It is true that greeniums, this discount becomes a little bit wider when you get to carbon intensive businesses. But I think part of that is because, one, you want in a diversified portfolio, my only access to a fossil fuel company might be the green bond of a fossil fuel company. So if I want a diversified portfolio, that's like hen's teeth, right? There aren't that many of them. When you get into those carbon intensive businesses, they're of lower credit quality. They're triple B. So the 6 basis points in a triple B is about as meaningful as maybe 1 or 2 basis points in a double A. You have to look at these greeniums relative rather than notional. That's why I think it's important to avoid being a forced buyer of any security. Then there's the whole greenwashing component. And there, for me, one, it runs the risk of destroying the credibility of the market itself. But I think we're okay well aware of that. But I mean, I think for me, it's more that the green bond or these sustainability linked bonds imply the transition is happening for a company. And if you think that transition means that that company will succeed, that transition is beneficial to the credit risk of the business. If for some reason they fail, then you've been misguided about the credibility of their sustainability objective that you buy into as an alpha story. So we're early stages at. My point is that so many companies are rushing to declare net zero or sustainability, but now we have to figure out what's the probability that you're going to get there and what time frame that you think you're going to get there. Let's go back to the green bond greenwashing thing. I mean, some of these green bonds that come out that no, they're not specific use of proceeds bonds. They say some of these bonds have been used to refinance mainstream bonds. And you're like, well, that's not a green project. But this company has really green credentials and they're really strong. And so I'm okay with that. It's the ones that don't have the green credentials, that don't have that really good green bond framework in place, and they issue green bonds that I'm worried about.
How do you protect yourself, or how do you deal with it?
This is where the internal investment frameworks that you have in place are really, really important. Let's say a company recently issued a green bond, and like I said, they refinance mainstream bonds, and you can say, well, that's not a green bond. And in traditional sense, it's not. But it is actually attached to a company that's got substantial green credentials. If we weren't looking at it in a more sophisticated way, we wouldn't look through the specific labeling. You need frameworks in place, skilled people that know what the right questions are, what are the follow-on questions to those answers, and to be able to test the credibility and credulity of the issuers that are putting them into the market. And that's just human capital, passion, and training and experience.
In terms of structuring, how do you judge whether penalty step-up mechanisms are important?
That's a great question. That is a really good question. And because right now, the step-up components are kind of all over the place. And because there are some norms that are forming the step-ups, let's just be clear, what is a step-up? A step-up is that if a company will establish a KPI, and that KPI will measure the company's ability to hit a certain target over some certain number of years. The sustainability-linked bond in particular has three key components: that KPI, the target, and a second-party opinion. Those are three key components, and that all links to the step-up, which is, I guess, the fourth component. Step-ups are a high-yield bond issuer is issuing a bond with a 25 basis point step-up. Well, NL just did, and their bond is being priced at sub 1%. So is 25 basis points the right step-up at a sub 1% bond or 4 or 5% bond? Again, relative to the size of the coupon, to me, the 25 basis points step-up on a high coupon bond is not punitive enough. It doesn't convey the kind of confidence that you would want to see from a company. Well, on one hand, it's great because they're declaring their intention to hit these targets, or they face a punishment. They face punitive increase in cost of capital. But that's more punitive on a relative basis to the very low coupon versus high coupon. We're collecting all the sustainability-linked bonds that come into the market and trying to better understand what the right coupon size should be. In my own view, I think there should be a floor, and then it should be sort of relative to the base coupon. And that can vary because your prevailing level of interest rate environment will change over time. So the market seems to be consolidated around 25 basis points in total, not even per KPI. I think that sort of fixed number isn't right. I think it should be sort of a floating number.
So I'm not trying to make any trouble here, but can these SDG-related step-ups somehow create perverse incentives for investors? In other words, some investors betting that they're not going to make it and kind of throwing money into these kind of guys?
It's a good question. That's like, I hope they miss so that I get my 25 basis point step up. I think in theory that kind of works, but it's in a vacuum of how investment decisions are made. One is you're investing in a thematic fund. You want them to succeed because it tells a great story for you, right? Like I invested in this bond and they completed their transition, and now I've got a case study, and the investors believe that your investment process is picking winners from a transition point of view. The second thing is that if the company's not hitting those targets for some reason, then it's probably because these targets, in a lot of cases, are not super ambitious. So they should be line of sight. So either their systems are wrong, their processes are wrong, they lied to you, there's something else that's more meaningful than the coupon. And if they don't, and there's not a credible reason for it, the credibility of the management is wrong. So in a vacuum, it's always better to get paid more than less. But if you look at the conditions of why it's paying for more, I think it undermines the desire to, in fact, pay, which in a lot of cases probably won't be that meaningful of a step up. It's not going to make you that much more money.
You also have mentioned several times about engagement as being key. And I think you've got something called the 4 milestone stakeholder engagement approach. How do you know that your engagement was causal or coincidental? How do you measure it?
No, this is a great question, because a lot of times you're engaging and others are as well. And sometimes you're part of a group engagement, in which case you will have set specific established engagements. And we get this question like, how do you know it's you that are having the impact? And in a lot of cases, part of the corporate culture, the change in the market, which we've been a long part of. Our engagement practice, our engagement process is 16 years in the making. And through those years, as you can imagine, it's become very structured. very formalized. And the result of that is that 4-step process. Someone sounds like Alcohol's Anonymous. It's anonymous, but that's 11 steps, I think. Not having been through it yet.
No, it's 12 actually.
12, thank you. You might be more experienced than I am, but I haven't been.
I just read about it. I mean,
Okay, I hear you. But I think that there are a couple ways. One is that if you see change that is specific to the milestone itself, think that change it was directly caused by you, if not joined with others. And we are leaders in this area. So a lot of times what we state sometimes will become what the company sets. So let me break that into two parts, because we have to talk about large companies and small companies. There could be several involved in the engagement process, but we'll work with others and we establish. And what you often sometimes see is that those goals become part of the sustainability agenda. Smaller companies, some of these companies we're talking to, how do we know that we've been a part of it? Because they've never had anyone engage on these. They've never had that kind of formal engagement relation. You talk about the high yield space in smaller companies. They might even be like, sorry, what is engagement? How does this work? I hear a lot about it. Sustainability is important. Why do you care? Tell me, why should I care? It's also incumbent on us just to be, we can't be myopic in an engagement process, right? I mean, we engage with our financial analysts and our engagement specialists work together. We can't be myopic about this, right? Companies have lots of demands on its cash flows. So we have to be well researched. We have to be credible, asking the same questions consistently, create these kind of frameworks and establish realistic goals. For smaller companies, the first step could be simply just to disclose data. And once companies are willing to make themselves vulnerable from that point of view, then to talk about establishing goals. When I say data, it's not just the simple things like carbon change. It could be reducing injuries and deaths per unit produced. Some companies would be like, you're a telecommunications company and your data policy is really poor and weak. We feel better as investors if we see a constructive data management digital policy. That's a specific outcome. Recently, we had a company and it's in the natural gas space and it wants to be perceived as a leader. It is now agreeing, it is now attaching management compensation to achieving its decarbonization objectives.
Right.
That's something that we suggested. It's also, how do you know you're successful? It's also the quality of the engagement, the partnership that you have, the discussion that you have, the back and forth. That's a successful engagement. Because the company now, whatever it does, whether it's a specific target, this is credible and this is going to happen. That's successful.
You've mentioned it several times now about that, someone's doing a successful transition. And I've spoken to a few people about transition bonds, and I understand there's some debate on transition bonds. And I guess I wanted to know what your opinion on transition bonds, and do you believe in them? Because I've spoken to some people who don't seem to.
So transition bonds were created, like many financial instruments, including the sustainability-linked bonds, in the entrails of some investment bank when a green bond failed, right? So a green bond came out by a certain company and the order book wasn't strong enough, and they came back and as far as I can tell, I looked at the two frameworks. The green bond and the transition bond had the exact same framework. It was just relabeled as a transition bond, and the book was 3 times top. Because it's a great story, and it's a story I believe in real transition. So look, the reality is that the labeled bonds are an important part of the market. Like all things and all people, or most people, they're neither entirely good or entirely bad. And so in this continuum between credible and substantial as labeling, where do they sit? Because for me, so what do I feel about them? I don't know. I don't really take that strong a view. I mean, I think it's a label that the banks have created. Maybe it helps to declares the company's intentions. What I care about is what's inside. Is the company is this really a true reflection of the company intention to transition from, say, brown to green? And by the way, why do we care about that? Well, I don't care if it's a green bond or transition bond, as long as it's what's happening with the company. So I'm not that impressed with the label. I'm impressed with maybe what its objectives are or trying to create. If it's really creating change at the company level, why do we care? Is because there is secular change happening in the economy, particularly in the case of climate change. And that's what transition bonds are talking about. If you look at corporate culture, if you look at regulation, if you look at the value chain, if you look at investors, if you look at fiscal policy, I mean, think about the European Recovery Plan, $750 billion for 4 years to spending climate change projects. Yeah. Look at Biden's infrastructure bill. Change is happening, and there are going to be winners and there are going to be losers. And the companies that will benefit from the ones that are looking through, that have this long-term view, so well-governed companies, and why does ESG matter? Companies with well-governed long-term view that are looking at transition risk. ESG matters, that's the environmental side of things, and trying to reposition their company for growth, to manage the risks, will change the economy, undermine their ability to create cash flows in some ways, or is an opportunity for them to grow cash flows. So if a transition bond has enough, is strong enough, and it's like the same thing with a sustainability linked bond, if they're strong enough to really reposition a company, then game on.
Who are your primary investors? And if they've changed, if you've observed any changes in the investor mix over the years. I'm not only asking about the SDG engagement fund, but also sustainable income funds.
So primary investors are pretty well balanced, I would say, across what we describe as institutional investors, which are pension schemes and like endowments and state government authorities. And what we call retail investors here, I would say advanced retail investors, which is like private wealth management, private wealth networks, those kinds of things. So when I say retail, although these are UCITS and the funds are open to the broad public, not necessarily the sort of you and I, shall we say, just going through the paper and picking a fund. So really, it's quite broad in that sense and global in nature as well, which is important to mention. I would say that how have investors changed is over time from sort of being, shall we say, ESG aware to ESG focused to then almost ESG determined in a way. A couple things are driving that. One is the elevated media focus on ESG, whether it's from a financial performance point of view, whether it's from a flows point of view, the changing demographics, the recognition that ESG factors are an enhancement to the investment process from both a risk management point of view and a performance driver. And then there are all sorts of exogenous forces that are having a real impact, such as regulation, stewardship codes, and I would call trade groups, for example, the Net Zero Asset Owners Alliance, the Paris Alliance. Much of those are the exact names, but these kinds of trade groups that are creating momentum, particularly in certain thematic areas, in particular climate change is a big one, and now biodiversity is becoming a big one. And so we're seeing a shift from what I would say from ESG integration to sort of purposeful capital. And finally, the last thing I would add is the investors are becoming increasingly sophisticated. Do you do ESG, or even how do you do ESG? Those are all assumed now. It's all of our investors are now testing us for our credibility and the credulity around those processes, in addition to fundamentals and the sort of the typical ways to invest. I mean, the questions we get are very detailed and demanding for data and performance metrics on sustainability factors.
I've been talking a lot about the UN SDGs, and some of them are linked to life on land and life underwater. And either the UN or the World Economic Forum have stated that our collective failure to date has been a failure to understand that nature underpins our global economic system. And they've cited figures, something like 50% of the global GDP is dependent on natural capital. And they've listed natural capital as one of the top financial risks of our time. And it seems like the climate debate is often focused or limited to temperature rises, but your mandate seems to be broader than that. What's Federated Hermes policy for biodiversity if all of those claims are true?
There isn't a specific biodiversity policy, but delivering into the SDG is natural for your questions, is a recognition of the balance we have in investing to create economic value that will deliver into a growing population so that everyone in the future can benefit from the things that we have now, but also mitigating damage and harm as much as possible on the environment around us. Now, to your point on biodiversity, we're talking about land use, water quality, water use, water preservation, temperature. Climate change is a big part of every single one of those, right? It touches all of that. So it's all kind of woven into that. And to that end, we in the fund and obviously in the SDG Engagement High Yield Fund, but also in our other funds that benefit from engagement, we are touching all of those environmental factors. Reforestation with paper companies and managing deforestation with agriculture, whether you all sort of ball that up into a specific biodiversity thematic, the SDG fund is bigger than that, or other funds are not narrow specific to biodiversity. But suffice it to say that the concept of sustainable wealth creation certainly contemplates that delivering investment returns and supporting economic growth and value creation has an impact on using those resources to get there. So it's just finding at the union of creating wealth and mitigating as much impact on the environment we live in, because depleting that is going to deplete our ability to generate value for future generations, and that's the main point.
All right, staying on the SDGs, the UN has a target of 2030 for the SDGs. And how do you quantify progress towards meeting those goals? Do you see that they are contributing sufficiently to meet the targets set to be achieved, I guess, less than 10 years' time now?
Yeah, I mean, it's clear that they are ambitious and aspirational, and that's okay. I think that we are, as a broader economy, underinvested in achieving those goals, which is why there's a level of urgency for private capital to partner with public capital to get there. There is still a capital deficit to deliver into that. Of course, I don't have numbers at my fingertips, but you can Google them, you can see what they are. I don't know whether the numbers are high or low or whatever, but it's clear that more needs to be done. And I'm quite sort of encouraged by what I see. And I see that sort of gaining momentum, given that governments are rapidly deploying regulation and capital in support of many of the SDGs. How do we measure it? I mean, we don't have I wouldn't call it quote like an SDG aligned fund in the sense that we have some charted pathway to each of the SDGs, but we remap all the sustainability activity in the SDG fund to the SDGs and set goals and track those versus companies. And if they fail, then for that fund, then we divest and redeploy capital to where we see better areas where potential can get converted into realized change.
Do you think realistically they'll be achieved? And if not, at least from a fixed income basis, what do you think is achievable by 2030?
I think to achieve the goals, we need rapid deployment of capital and policy to get there from here. The point is, we all need to make sincere effort to get there. Once you conspire to get to that sort of altruistic objective, just transition, sustainable wealth creation, all those kinds of things, then you've got momentum and you're a lot better off in that way. And you've restructured the economy to support that. And you're a lot better off than where we were 10 years ago.
And there's a lot of momentum now.
Yeah. Look, they're ambitious, right? I mean, they're ambitious and they were always ambitious and they were always aspirational, and that's okay.
We don't have all the answers yet, but humanity has been very good at proving that you can work on solutions and come up with it. I mean, I always tell people, like when I was sitting in primary school, I mean, literally, we were being told that the world's going to run out of oil in about 7 or 8 years, right?
That's it. Yeah. I mean, I think the key thing there is, like always, when I was in school, at the end of the economic model, there was a factor why. You're like, what is that? It's like technology. It's like, but what is that? It's technology. It's like, but we haven't created it yet. So it's like there's technology, innovation, all that kind of stuff that can sit in front of us. And if there's money to be made in those areas, then it'll accelerate faster, which is why I think government involvement is important, because like hydrogen energy, for example, I think that early deployment of government money can reduce risk. And if that reduces risk, it reduces risk premia, and that lowers the barrier to entry for capital. And that's the key thing. And then once you lower the barrier to risk capital, then it opens it up to broader sources of capital to finance that change.
And I think like one thing that's completely outside of this SDG system is something like, what I think Elon Musk single-handedly did. So he created I think it's $100 million US prize for the best innovation to scrub CO2 out of the atmosphere. And that is completely independent of all this. It's going to achieve some result. I'm sure of it. And that's going to produce technology. And we've seen through COVID how when you get technology companies and people focused on finding solutions, they do come up with solutions if you create the right environment.
That's an interesting point, because I think you're right. What we have now is we've got an urgent problem whose timing is less so. Whereas COVID, it was an urgent problem whose timing was immediate. And climate change is a tough one because it is immediate as climate works. I mean, climate is the sum total of weather. It's cold, like, there's no such thing as global warming. It's like, but it doesn't work that way. And so that's the challenge. There is an urgent need now, but there is a delay in it. Sort of On Monday, the water's up to my ankles. On Tuesdays, it's up to my calves. By Friday, it's up to my knees. And then you're like, oh, the water's rising.
There was an immediate touch aspect to COVID. I mean, there
Correct.
wasn't. Climate change is a bit more elusive because it happens very, very slowly.
That's right. But it's a good dress rehearsal for climate change, isn't it? But also the solution to COVID was also immediate, right? Like you come up with the vaccine and you can inject it. What's the vaccine for climate change? It takes years to figure out, right?
Maybe until we get the right technologies.
Yeah.
I don't know. I mean, what do I know? I've been in a science class since secondary school, so I'm not the guy to ask, right? So listen, I've got a few last questions. But yeah, kind of rapid fire. Just give me whatever comes to your mind, or feel free to take a pass. If you had to name the one most important challenge in the sustainable fixed income space at this time, what would it be?
That's actually fairly straightforward. To succeed, you need to assess and you need to measure and you need to report. All of that in order to understand the problem. And for that, where we have problems is data. And data, and also something that's going to be a little bit idiosyncratic to fixed income risk is mapping of data, because a lot of the data is earmarked for equity. And then in a lot of cases, you can map the fixed income world to the equity world and therefore obtain all the data. But in a lot of cases, mapping to the equity ticker so you can access the data is very difficult from a fixed income point. Like you have an operating entity that sells bonds. Sometimes what's the carbon footprint of that entity? Is it the entire company? No. So accurate data and mapping to data. So getting to the data and obtaining data, particularly as you get to the smaller companies, as you get out of large cap investment grade, which is very equity-like in terms of data disclosure and data mapping. But then as you get smaller into EM and into sovereign, it's extremely difficult. That's the big challenge.
If you can't measure it, you can't act on it.
And that's why equity is moving a little bit faster. I think there's a lot of interest in this, though. I think we're getting there in terms of intent and corporate culture and things like that.
What do you know now about sustainable fixed income investing that you wish you had known in 2010 when you showed up at Federated Hermes?
Ooh. What have we learned over time is how to create more precision in the sort of the assessment process. Like, this is a difficult one, but which areas to weight? What are the most material factors in each sector? Yeah, that's what I wish. Understanding the materiality of factors, the right questions to ask, and how to weigh those, the weight of those in your investment framework.
Would another way to say that is not everything is equally important, and maybe you had a harder time distinguishing that.
Yeah, having a much better feel for what are the most important, what are the most material factors by sector, and how to convert that into investment value thinking.
You don't have to name any names, but could you describe for me an example of an investment that you were pretty convinced at the time you invested it ticked all your boxes, but in the end it didn't turn out, it went pear-shaped? What did you learn from that?
Not everything is under management's control, despite their intention. Even if there's a willingness and desire to have control and convey that they do, not everything is under their control. And that's just a fact of life.
Was there an investment that you were skeptical of, either at the time you invested, or maybe you were so skeptical you passed on it, and in the end, it really turned out way better than you thought, and you were pleased that you had invested? Or if you passed on it, maybe you wish you hadn't. What did you learn from that?
I think what I would say is more so is that I've been really surprised most recently by companies in the most carbon-intensive industries, how quickly they have shifted from superficial interest in mitigating climate change to accelerated interest in mitigating climate change. And I mean, we're talking about energy companies and steel makers, that cement makers, building materials, the largest contributors, and how quickly they've seen the light. I think it was wait, go, because they see that the economy is in structural change and they want to be on the right side of that for lots of reasons.
Do you think the genesis of that is pressure being applied, or do you see that somehow they're seeing it now as a competitive advantage in terms of the bottom line?
I think it's one, a combination of bottom up from investors, two, top down from regulation, and three, that they see value in it because the companies that buy from them, so the upstream companies or is that downstream? But I think the downstream companies are looking up through the value chain and saying, I'm changing, so I'm going to buy from people that are changing, and they're looking for that. So I think it's a combination of profit, investors, and regulation.
If someone wants to get into the sustainable fixed income space, how would you advise them to get in the business? Like, what's the best place or way for them to cut their teeth?
I think in the investment business, well, I mean, to state the most obvious is to join a firm that has made it a priority through the investment process to learn how the implementation of sustainability in the investment process works, the challenges, and how to get over them. I mean, I would say something that's pretty anodyne, I suppose, just as I would like, we'll take specialized education courses, but that's pretty obvious. But I think if you come from literally nowhere, you develop some kind of street cred, some sort of credibility of interest in order to at least get in the door, because it's a crowded trade to get in the door right now.
Listen, Mitch, I'll let you go. Thanks very much. I appreciate it.
Okay, cool. Thank you.
All right.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.